All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another sensational headline designed to get clicks. This is about a massive capital reallocation that just happened at Blackrock, the world's largest asset manager with over $11 trillion under management, and the implications are so profound that if you don't understand what this means for your wealth, your savings, and your financial future, you could be caught on the wrong side of the largest wealth transfer in modern history. BlackRock just moved $500 billion out of traditional equity positions and into what they're calling defensive allocations. Now, if that number doesn't immediately alarm you, let me put it in perspective. $500 billion is larger than the entire GDP of Sweden. It's more than the market capitalization of Tesla and Meta combined. And when an institution of BlackRock's size makes a move this dramatic, it's not because they're guessing, it's because they have access to data, to flows, to institutional intelligence that retail investors will not see until it shows up in their quarterly statements as losses. This is not a portfolio rebalancing. This is not tactical allocation. This is a signal that the smart money, the institutional capital that moves markets, sees something coming that is going to reshape the investment landscape. And in this video, I'm going to walk you through exactly what BlackRock knows, why they're repositioning now, what this means for the average investor who's still sitting in a traditional 60-40 portfolio, and most critically, the three asymmetric plays you need to understand right now to not just protect your wealth, but position yourself to benefit from the dislocation ahead. By the end of this breakdown, you will have a clear framework for understanding systemic risk, a historical context that shows this pattern has played out before with devastating consequences for the unprepared, and an action plan that you can implement this week. So turn off the distractions, grab a notepad, and let's break down what BlackRock's $500 billion move really means, because this is not a drill. Before we dive into the mechanics of what BlackRock is doing and why it matters, you need to understand the foundational framework that governs how institutional capital thinks about risk in late-cycle environments. I call this the asymmetric risk framework, and it's built on a principle that most retail investors completely ignore. In a bull market, everyone looks like a genius. Returns are easy. Passive index funds generate double-digit gains, and the biggest risk seems to be missing out on the next 10% move higher. But in a late-cycle environment, when valuations are stretched, when debt levels are at historic highs, when central bank policy is trapped between inflation and recession, the entire calculus changes. The asymmetry flips. Your downside risk becomes catastrophic while your upside is marginal. And the sophisticated players, the BlackRocks of the world, they don't play that game. They don't try to squeeze out the last 5% of a bull market when they can see the structural imbalances building. They rotate capital. They move into positions that preserve wealth in a downturn and that benefit from the inevitable policy response. That's what we're seeing right now. BlackRock is not panic selling. They're systematically repositioning $500 billion because their models, their risk management frameworks, and their access to order flow data are telling them that the risk reward of staying long traditional equities at current valuations is no longer favorable. And here's what's critical. When BlackRock moves, they move the market. $500 billion in selling pressure, even if it's executed gradually over weeks or months, creates a gravitational pull that affects prices, sentiment, and flows across the entire system. Other institutions see it. They start positioning defensively. Momentum shifts. And by the time retail investors realize what's happening, the damage is already done. The thesis of this video is straightforward. We are at a critical juncture where the largest institutional players are de-risking ahead of a macro event that they see coming, but that has not yet materialized in headlines. The signal is BlackRock's $500 billion rotation. The context is unsustainable debt levels, geopolitical instability, and a central banking system that has exhausted its traditional tools. And the asymmetric opportunity is in the assets that benefit from systemic dislocation, specifically precious metals, deep value distressed credit, and hard real assets. If you understand this framework, you can position yourself on the right side of the trade. If you ignore it, you're taking on uncompensated risk at the worst possible time. Now, let's ground this in history, because this pattern of institutional capital rotating out of risk assets ahead of major dislocations has played out multiple times, and the investors who recognized the signals early were the ones who preserved and multiplied their wealth. The first parallel I want you to understand is 1929 and the lead up to the Great Depression. Most people remember the stock market crash of October 1929 as a sudden, unexpected event. But that's a fundamental misunderstanding of what actually happened. In the months leading up to the crash, institutional investors and sophisticated traders were already seeing the warning signs. Margin debt had reached unsustainable levels. Valuations on blue-chip stocks were trading at multiples that had no historical precedent, and critically, the credit markets were starting to show stress. Insider selling accelerated. The smart money, people like Joseph Kennedy and Bernard Baruch, had already exited their positions or taken short exposure. They understood that the euphoria was built on leverage, that the underlying economy was weakening, and that when the credit cycle turned, the cascade would be brutal. And they were right. When the crash came, it wiped out 89% of the stock market's value over the next 3 years. But here's what's critical. The investors who preserved their wealth during this period were not the ones who tried to time the exact top. They were the ones who recognized the structural imbalance and rotated into cash, into gold, into Treasury securities before the panic hit. And after the crash, they were the ones with the capital to buy productive assets at pennies on the dollar. The lesson from 1929 is not about predicting the exact timing of the crash. It's about recognizing when risk-reward is no longer in your favor and having the discipline to reposition before the herd realizes what's happening. The second historical parallel is the dot-com bubble of 1999 and 2000. And this one is particularly relevant because we're seeing similar valuation dynamics today in large-cap technology stocks. In 1999, the Nasdaq was trading at valuations that defied any rational financial analysis. Companies with no earnings, no cash flow, and no viable business models were valued in the billions. The narrative was that the internet had changed everything, that traditional valuation metrics no longer applied, and that anyone who questioned the rally was simply too old or too slow to understand the new paradigm. But behind the scenes, institutional investors were quietly exiting. Warren Buffett famously refused to buy technology stocks at those valuations and was mocked for being out of touch. George Soros and Julian Robertson closed their funds or dramatically reduced exposure because they couldn't reconcile the valuations with any fundamental framework. And when the bubble burst in March 2000, the Nasdaq lost 78% of its value over the next 2.5 years. Trillions of dollars of wealth evaporated. Retail investors who had piled in at the top watched their portfolios get cut in half, then cut in half again. But the institutional players who had rotated out in 1999, who had been willing to underperform for 6 or 12 months while the bubble inflated further, came out the other side with their capital intact. And they were the ones who bought the distressed assets in 2002 and 2003 and made generational returns in the recovery. The lesson from the dot-com crash is that when everyone is telling you that this time is different, when valuations have disconnected from fundamentals, and when institutional players are quietly exiting, you need to pay attention. The third historical case study is 2007 and the lead up to the global financial crisis. And this one is the most directly comparable to what we're seeing today because it was driven by debt, by leverage, and by a credit market that had become systemically fragile. In 2006 and early 2007, the housing market in the United States was showing clear signs of stress. Subprime mortgage defaults were rising. Home prices were flattening and beginning to decline in some markets, and the credit spreads on mortgage-backed securities were starting to widen. But the stock market kept going up. The narrative was that housing was a localized issue, that the broader economy was strong, and that any pullback would be shallow and short-lived. Meanwhile, institutional investors who understood the mechanics of the mortgage market and the leverage embedded in the financial system were quietly de-risking. John Paulson famously made billions by shorting subprime mortgage securities. Goldman Sachs reduced its exposure to mortgage-backed securities and even took short positions against the very products they were selling to clients. These were not lucky guesses. These were calculated bets based on understanding that the system was over-leveraged, that the collateral was fraudulent, and that when the credit cycle turned, the losses would be catastrophic. And when the crisis hit in 2008, the S&P 500 lost 57% from peak to trough. The financial system came within hours of complete collapse. Major banks failed. Bear Stearns, Lehman Brothers, Washington Mutual, gone. And trillions of dollars of household wealth was destroyed. But the investors, who had heeded the early warnings, who had reduced risk exposure, who had moved into cash and treasury securities, not only preserved their wealth, but were positioned to buy assets at generational lows in 2009. The lesson from 2008 is that when credit markets start showing stress, when institutional players are reducing exposure, and when the system is over-leveraged, you do not want to be the last one holding the bag. So what connects all three of these historical periods? And why does BlackRock's $500 billion move fit the same pattern? In each case, the institutional players had access to better information and better risk management frameworks than retail investors. They could see the imbalances building. They understood that valuations were unsustainable or that leverage was too high. And critically, they had the discipline to exit before the crowd panicked. In 1929, it was insider selling and rotation into cash before the crash. In 2000, it was institutional exits from technology stocks, while retail was still buying. In 2007, it was Goldman Sachs and hedge funds shorting mortgages while the banks were still selling them. And now in 2026, it's BlackRock moving $500 billion out of traditional equities into defensive allocations. The pattern is unmistakable. When the smart money moves, you need to pay attention. So let's talk about what BlackRock is actually doing with this $500 billion and why it matters so much. According to filings and institutional data that came out in the last 2 weeks, BlackRock has systematically reduced its exposure to large-cap growth equities, particularly in the technology sector, and reallocated that capital into 3 primary buckets. First, they've increased their allocation to short-duration Treasury securities and investment-grade corporate bonds. This is a classic defensive move. When you expect volatility or a potential drawdown in risk assets, you move into fixed income that preserves capital and provides liquidity. The fact that they're favoring short duration tells you they're not expecting inflation to accelerate dramatically in the near term. They're expecting a deflationary shock or a risk-off event where safety and liquidity are paramount. Second, they've significantly increased their holdings in precious metals and commodity-linked assets. This includes direct positions in gold and silver ETFs, as well as equity stakes in senior mining companies and royalty firms. This is a hedge against currency debasement and a bet that central banks will be forced to ease policy aggressively if a crisis materializes. Third, and this is where it gets really interesting, they've been quietly accumulating distressed credit and special situation assets in sectors that have been beaten down. This includes commercial real estate debt trading at significant discounts, energy infrastructure assets, and certain emerging market debt that's been oversold. This is classic BlackRock playbook. They're positioning to buy the dip, but they're doing it in areas where the distress is already priced in and where the asymmetric upside is substantial if the market stabilizes. Now here's why this rotation is so significant. BlackRock does not make moves like this based on short-term trading opportunities. They manage institutional capital for pension funds, sovereign wealth funds, and endowments with long-term mandates. When they move $500 billion, it's because their multi-decade risk models are telling them that the current environment has characteristics that historically precede major dislocations. And what are those characteristics? Let's break them down one by one. First, global debt has reached levels that are mathematically unsustainable. According to the Institute of International Finance, total global debt hit $315 trillion in 2025, which represents over 330% of global GDP. To put that in perspective, that's higher than at any point in history outside of the immediate aftermath of World War II. And here's the problem. That debt was accumulated in an era of zero interest rates. Now that rates have normalized to the 4 to 5% range, the cost of servicing that debt has exploded. Governments, corporations, and households are facing a choice. They either have to dramatically reduce spending to service the debt, which kills economic growth, or they have to default or inflate the debt away, which destroys currency value. There is no third option, and BlackRock's models understand this. They know that the end game for unsustainable debt is either a deflationary collapse or an inflationary debasement, and both scenarios are terrible for traditional equity portfolios that are priced for perpetual growth. Second, geopolitical instability has reached a level where the probability of a black swan event, a war, a supply chain disruption, a financial contagion, has increased materially. We're seeing decoupling between the United States and China. We're seeing energy security concerns in Europe. We're seeing instability in the Middle East that could disrupt oil flows. And we're seeing the BRICS nations actively working to create alternative settlement systems outside the dollar. Any one of these factors could trigger a risk-off event that sends capital fleeing out of equities and into safe haven assets. And BlackRock is positioning for that scenario by increasing liquidity and moving into assets that benefit from geopolitical stress. Third, and this is the mechanism that most retail investors completely miss, the Federal Reserve and other central banks are trapped. They cannot raise rates further without triggering a debt crisis and a recession, but they also cannot cut rates aggressively without reigniting inflation and losing credibility. They are stuck in what economists call a policy bind, and historically, when central banks are trapped, markets become extremely volatile and prone to sharp corrections. BlackRock's rotation out of risk assets is a direct acknowledgement of this policy bind. They're not betting on a specific outcome. They're positioning for high volatility and tail risk, which means reducing exposure to assets that perform poorly in chaotic environments and increasing exposure to assets that preserve value or benefit from central bank intervention. Now let's talk about the quiet mechanism that makes this move even more significant than the headline number suggests. When Blackrock moves $500 billion, they don't just sell stocks and buy bonds in a vacuum. They influence flows, sentiment, and positioning across the entire institutional landscape. Here's how it works. BlackRock is the largest shareholder in hundreds of publicly traded companies. When they reduce their positions, even by a few percentage points, it sends a signal to other institutional investors. Pension funds, mutual funds, and hedge funds all track BlackRock's 13F filings. They see the rotation happening, and they start asking themselves whether they should be doing the same. This creates a cascade effect where institutional selling begets more institutional selling. And because institutions control the vast majority of trading volume in the market, this kind of coordinated de-risking can shift the entire market structure. The second mechanism is liquidity. $500 billion in capital being moved out of equities and into fixed income and alternative assets reduces the overall liquidity in the equity market. And when liquidity decreases, volatility increases. Small shocks that would have been absorbed in a high liquidity environment now cause outsized moves. This is why we're seeing increased intraday volatility and why the VIX, the volatility index, has been creeping higher, even though the market has been relatively stable on a day-to-day basis. The institutions know that liquidity is draining, and they're pricing in the risk that a future shock will be amplified. The third mechanism is the signal it sends to retail investors, though most retail investors don't understand what they're seeing. When a stock that has been a darling of institutional portfolios suddenly sees heavy selling, retail investors often interpret that as a buying opportunity. They think the institutions are overreacting or that the stock is now undervalued. But what they don't realize is that the institutions have better information, they have better risk models, and they're not selling because they think the stock is overvalued by 10%. They're selling because they think the entire market structure is at risk of a 30 to 50% drawdown, and they don't want to be holding equities when that happens. This is the retail trap, and it plays out in every major market correction. The institutions exit early, retail buys the dip, the market continues to decline, and retail holds all the way down, hoping for a recovery that doesn't come until much later. So if BlackRock is positioning for a major dislocation, what are the three asymmetric plays that allow you to not only protect your wealth, but position yourself to benefit from the chaos ahead? Let me be very clear about this. The first asymmetric play is physical precious metals, specifically gold and silver, held outside the banking system. This is not about speculation. This is not about trying to time a 20% move in the gold price. This is about understanding that in a systemic crisis, where confidence in fiat currency erodes, where central banks are forced to print money to bail out the system, and where capital controls and financial repression become the norm, physical precious metals are the only assets that have zero counterparty risk and cannot be devalued by government decree. Right now, gold is trading near all-time highs around $2,900 per ounce, and the narrative you'll hear from mainstream financial advisors is that gold is expensive, that it doesn't generate cash flow, and that it's a barbarous relic. But here's what they're not telling you. Central banks around the world just completed the largest year of gold purchases in history. China, Russia, India, Turkey, and Middle Eastern sovereign wealth funds added over 1,200 tons of gold to their reserves in 2025. That's not portfolio diversification. That's a strategic move away from dollar-denominated assets and toward hard monetary assets. These central banks have access to the same data that BlackRock does. They see the unsustainable debt levels. They see the policy bind. And they're buying gold because they know that when the system resets, gold will be the settlement asset. Silver offers even more asymmetric upside because it's trading at a historically wide ratio to gold. The gold-to-silver ratio is currently around 90-1, meaning it takes 90 ounces of silver to buy 1 ounce of gold. The historical average is closer to 60-1, and during periods of monetary stress, that ratio has compressed as low as 15-1. If silver simply mean reverts to the historical average, it would need to appreciate by 50% relative to gold. And if we see a monetary crisis where both metals surge, silver could easily outperform gold by a factor of 2 or 3 due to its smaller market size and its dual role as both a monetary metal and an industrial commodity. The move here is to allocate a meaningful percentage of your liquid net worth, at minimum 10 to 20%, into physical gold and silver that you either hold directly or store in a fully allocated, segregated vault outside the banking system. Not paper ETFs that are claims on metal you don't control, not mining stocks that are leveraged bets with operational risk, physical metal that you own outright. The second asymmetric play is senior precious metals, mining companies and royalty firms with Tier 1 assets in stable jurisdictions. This is the leverage play on the underlying metal price. When gold moves from $2,900 to $4,000, which is entirely plausible in a scenario where central banks ease aggressively or where geopolitical stress intensifies, the miners don't just benefit linearly, they benefit exponentially. A mining company with an all-in sustaining cost of $2,500 per ounce is currently generating $1,400 per ounce in free cash flow at a $2,900 gold price. If gold goes to $4,000, that same company is now generating $2,500 per ounce in free cash flow, nearly doubling their profitability. The market values these companies on multiples of cash flow, so a doubling of cash flow can easily translate to a tripling or quadrupling of the stock price. The key is to focus on quality. You want companies with long reserve life, low political risk, strong management teams, and balance sheets that can withstand volatility. Names like Newmont, Barrick Gold, Franco-Nevada, and Wheaton Precious Metals fit this profile. These are not speculative junior miners. These are established producers with diversified asset bases and the financial strength to operate through any market environment. The asymmetry here is that you're buying these companies at valuations that assume gold stays range-bound or declines. But if the thesis plays out and we see gold move materially higher due to monetary instability, these stocks will deliver multi-bagger returns while your downside is limited by the fact that these companies are profitable at current metal prices. The third asymmetric play is distressed credit and deep value in sectors that have been oversold due to structural pessimism. This is where Blackrock's playbook becomes instructive. They're not just moving into defensive assets. They're also positioning in areas where the distress is already priced in and where the asymmetric upside is substantial. Right now, commercial real estate debt is trading at significant discounts to par because the market is pricing in a wave of defaults and foreclosures. Office buildings in major cities, retail properties in secondary markets, these assets are being valued as if they're worth zero, but the reality is more nuanced. Some of these properties have strong cash flows, good locations, and manageable debt structures. They're being sold at distressed prices, not because they're worthless, but because there's a liquidity crisis in the market and no one wants to catch a falling knife. If you have the capital and the expertise to underwrite these assets properly, you can buy senior secured debt at 60 or 70 cents on the dollar, collect double-digit yields, and either hold to maturity or take control of the asset if the borrower defaults. This is exactly what the distressed debt funds did after 2008, and many of them generated 30 to 50% annualized returns over the next 5 years. The asymmetry is that your downside is protected by the senior secured nature of the debt and by the underlying collateral. Your upside is either a return to par as the market normalizes or control of the asset at a basis that's 30 to 40% below replacement cost. For retail investors, the cleanest way to access this is through publicly traded business development companies or distressed debt funds that specialize in this strategy. These vehicles typically trade at discounts to net asset value during periods of market stress, and they offer high single-digit or low double-digit dividend yields that are covered by cash flow. So what do you need to do right now? Let me give you a concrete action plan, because understanding the thesis is worthless if you don't implement it. First, you need to assess your current portfolio and understand your exposure to systemic risk. If you're heavily weighted in large-cap technology stocks, if you're holding long-duration bonds, if you have significant cash in banks above FDIC insurance limits, you are overexposed to the risks we've discussed. The immediate action is to reduce concentration risk and increase diversification into assets that perform well in volatile or crisis environments. Second, you need to establish a position in physical precious metals if you haven't already. I recommend a minimum allocation of 10% of your investable assets in physical gold and silver. If you're more risk aware or if you understand the asymmetry deeply, push that to 15 or 20%. Buy from reputable dealers, take delivery or use fully allocated storage, and do not treat this as a trade. This is insurance. This is wealth preservation. This is the asset that protects you when everything else is declining. Third, you need to consider adding exposure to senior mining companies and royalty firms. A 5 to 10% allocation to high-quality precious metals miners gives you leveraged upside to a move in the underlying metals, while diversifying away from pure financial assets. Use dollar-cost averaging to build the position over time and focus on quality over speculation. Fourth, if you have significant capital and a longer time horizon, start researching distressed credit opportunities. This requires more work and more due diligence, but the asymmetric returns are substantial for those who do the homework. Look for senior secured debt trading at significant discounts, focus on assets with hard collateral, and make sure you understand the legal structure and recovery process. Fifth, stay informed and stay flexible. This is not a static environment. BlackRock's move is a signal, not the end of the story. The situation will evolve, central bank policy will shift, geopolitical events will unfold. And you need to be monitoring the landscape continuously so you can adjust your positioning as new information becomes available. Follow institutional flows, read the primary sources, and think independently about what the data is telling you. Here's the question I want you to answer in the comments because I want to know where this community stands. Do you believe BlackRock's $500 billion rotation is a defensive overreaction, or is this the early warning signal of a major market dislocation in the next 12 to 24 months? I want to hear your perspective because the diversity of thought in this community is what makes it valuable. And if you found this breakdown valuable, if you understand why BlackRock's move matters and why positioning now is critical, I need you to do two things. First, hit that subscribe button and turn on notifications because we're going to be tracking this story as it develops. I'll be covering institutional flows, central bank policy, precious metals markets, and distressed opportunities in real time. And you need to be plugged in if you want to stay ahead of the curve. Second, share this video with anyone you know who cares about protecting their wealth. The people who are going to be hurt the most by the coming dislocation are the ones who don't have access to this information, who trust that their financial advisor has their best interests at heart, and who won't realize what happened until it shows up in their account statements. This is not about fear, this is about preparation, and preparation is the difference between being a victim of the reset and being a beneficiary of the wealth transfer. BlackRock just moved $500 billion. They know what's coming. The only question is whether you're going to act while you still have time or whether you're going to wait until the exits are closed. I'll see you in the next one. Stay sharp, stay prepared, and stay ahead of the curve.